Disclaimer.
Picture this scenario. You're managing a pension fund with billions in assets. You just closed 2024 with a $62 billion surplus, and you're feeling pretty good about your year. Then January 2nd arrives, and your investment committee walks into the conference room with a problem that is about to reshape the entire precious metals market. You have zero silver in your portfolio, not a single ounce. And that's about to become the most expensive oversight in modern pension fund history. Here's what most people don't understand about how our pension system actually works. When you're managing money for teachers, firefighters, and nurses who are counting on that retirement check in 20 years, you can't just park everything in stocks and hope for the best. Our pension funds operate under strict mandates that force them to rebalance their portfolios at the start of each year, buying more of whatever performed best and trimming what underperformed. It's a mechanical process written into their bylaws. And in January 2026, that mechanical process is about to collide with a market that's physically too small to absorb what's coming. Pop quiz. What was the best performing major asset class of 2024? If you said tech stocks or Bitcoin, you're thinking too narrow. Silver gained 67% last year, while pension funds sat on the sidelines with exactly zero exposure to the metal. According to the World Gold Council's institutional survey, pension fund managers ended 2024 with their portfolios overweight in bonds that barely kept pace with inflation and stocks trading at valuations that made even the optimistic analysts nervous. They watched silver climb month after month, and their compliance officers are now telling them they have to fix that gap. But here's where it gets interesting. When we talk about $50 billion moving into silver, we're not describing a normal investment flow. We're describing what happens when the rules say you must buy something, and there's literally not enough of it available to satisfy the demand. Let me put this in perspective for you. The entire annual silver market is worth about $25 billion when you add up everything mined globally in a year. Think about that math for a second. If pension funds need to deploy $50 billion into silver just to meet their rebalancing mandates, they're trying to buy twice the world's annual production. That's not investing, that's a supply crisis disguised as portfolio management. The mechanism driving this is what institutional investors call the 60-40 portfolio death. For decades, our pension funds followed a simple rule. Put 60% in stocks, 40% in bonds, rebalance annually, and retire comfortably. That strategy worked beautifully when bonds actually paid meaningful yields and when inflation stayed dormant. But something broke in that equation over the past few years. According to Federal Reserve data, real yields on our 10-year Treasury bonds spent most of 2024 barely positive after accounting for inflation, and corporate pension actuaries are now staring at a world where their traditional safe havens do not protect purchasing power anymore. This forces pension managers into an impossible situation. They're legally required to meet future obligations, they're watching inflation erode bond returns, and they're prohibited from taking excessive risk with retiree money. So they're hunting for something that hedges inflation, trades in liquid markets, and hasn't already run up to bubble valuations. That list is getting very short, and silver just became the answer, whether pension managers like it or not. Now, here's the part that should grab your attention. When these institutions finally decide to buy physical silver, they're discovering there's a problem in the vaults. London Silver Holdings hit 2,126 metric tons by the end of 2024, down from 31,023 metric tons in 2022. That's a drop of nearly 30% in available inventory, and it is happening right as the biggest wave of institutional buying in a generation prepares to hit the market. The Bank for International Settlements tracks these vault levels because they matter for global financial stability, and the trend line is pointing straight down at exactly the wrong time. Think about what happens when you try to force $50 billion through a door built for $25 billion of annual flow. The price doesn't just climb gradually, it teleports to whatever level is required to ration the limited supply among desperate buyers. We saw glimpses of this dynamic in October 2024 when physical premiums on silver eagles spiked to $90 over spot prices. Dealers were literally putting silver on airplanes between London and New York because the shortage in specific markets got that severe. Lease rates in London hit 200% annualized as traders scrambled to borrow metal they couldn't buy outright. Those were just tremors compared to what's building for January. The calendar is what makes this urgent. January the 2nd isn't just another day on the trading calendar for institutional investors. It's when our pension funds, endowments, and insurance companies execute their mandatory annual rebalancing. Investment committees that spent December reviewing performance and adjusting allocations will return from the holiday break with approved purchase orders that must be executed in the first weeks of the new year. According to Morningstar's institutional survey, over $12 trillion in U.S. pension assets follows some version of annual rebalancing protocol. And when these mandates all fire at once, markets move in ways that surprise even the professionals. What makes this different from normal institutional buying is the word mandate. When a pension fund wants to buy something, they can be patient, scale into positions, wait for better prices. But when their compliance rules say they must rebalance by January 31st to maintain proper asset allocation percentages, patient goes out the window. They become what traders call indiscriminate buyers, meaning they'll pay whatever price is required to fill their orders before the deadline. You might be wondering why this wasn't a problem in previous years. The answer is those pension fund surpluses we mentioned. Corporate pension funding ratios jumped from 99.5% at the start of 2024 to 1.5% by year end, creating roughly $68 billion in excess capital that investment committees now have to deploy. According to Milliman's corporate pension funding study, this is the first time in over a decade that our pension system has had this much surplus capital requiring allocation all at once. In past years, pension funds were in deficit mode, managing liabilities, not deploying windfalls. Now they have cash burning a hole in their pocket. Traditional assets look overvalued or underperforming, and the rulebook says they need to own what worked last year. Here's the reality we're facing as Americans, watching our retirement systems navigate this shift. When $50 billion of institutional capital tries to squeeze into a market with only $25 billion of annual supply, someone's going to get hurt. Either pension funds pay dramatically higher prices to secure the metal they need, or they fail to meet their rebalancing mandates and face compliance issues. Neither outcome is pleasant, but one of them is about to reshape our understanding of what silver is worth in an institutional portfolio. The mechanism is already in motion, the deadlines are set, the mandates are written, and the metal isn't there in the quantities required. What happens next isn't speculation, it's arithmetic. Now, let me show you exactly why this shortage is not some temporary squeeze that resolves itself in a few weeks. We're looking at the 5th consecutive year of structural deficit in the silver market. And the numbers tell a story that most investors haven't fully processed yet. According to the Silver Institute's World Silver Survey, our global silver market will run a deficit of 95 million ounces in 2025. That might not sound dramatic until you realize this is year 5 of the same trend. Since 2021, we've accumulated a total shortage of 820 million ounces. Think about what that means in practical terms. We've been consuming more silver than we mine for 5 straight years, drawing down existing stockpiles, and nobody's turning on major new mines to fix the problem because silver prices have not been high enough to justify the capital investment. Until now. Here's where the math gets uncomfortable for anyone betting this shortage resolves easily. Industrial demand for silver is projected to hit a record 700 million ounces in 2025, and that number keeps climbing because of 3 sectors that are not slowing down no matter what happens to the economy. Solar panel manufacturers need silver paste for every photovoltaic cell they produce, and global solar capacity is expanding faster than ever as countries race to meet climate commitments. AI data centers require silver in their server components and power infrastructure, and tech companies are building these facilities at a pace that would have seemed insane just 5 years ago. Electric vehicles use roughly twice as much silver as traditional cars, and automotive manufacturers have already committed billions to EV production lines that can't just shut down if silver gets expensive. What makes this different from typical commodity cycles is that these aren't discretionary uses. You can't build a solar panel without silver paste that conducts electricity efficiently enough to make the economics work. You can't run a hyperscale data center without the electrical contacts and thermal management systems that require silver's unique properties. And automotive manufacturers signed contracts years ago that lock them into production schedules they must meet or face massive penalties. This demand is structural, it's growing, and it's competing with investment demand for the same limited supply. Let me take you inside what actually happened in October 2024 when the physical market gave us a preview of what is coming. Lease rates in London spiked to 200% annualized, which is a number that should make you stop and think about what it means. When someone is willing to pay 200% annual interest to borrow silver for a few weeks, they're not doing it for fun. They're desperate to deliver metal they sold but don't actually have, and they're discovering that physical silver isn't sitting in warehouses waiting to be borrowed anymore. Traders were literally booking cargo space on passenger airlines to move silver between London and New York because the shortage in specific delivery locations got so severe that the premium for having metal in the right city justified flying it across the Atlantic. According to dealer reports from Monument Metals and APMEX, physical premiums on American Silver Eagles hit $90 over the spot price in some markets. I'll let that sink in for a moment. The paper price said one thing, but if you actually wanted to hold a 1-ounce coin in your hand, you paid almost double the quoted market price. This is what happens when paper markets and physical markets diverge. You can trade silver futures contracts all day long, moving billions of dollars with a few keystrokes, but when someone actually wants delivery of the metal, the system discovers there's a lot less available than the paper trading suggested. The October squeeze resolved itself temporarily because industrial users delayed purchases and some investors sold back into the premium. But that release valve doesn't work anymore when pension funds show up with mandates requiring physical allocation. Now let's talk about where all this surplus pension money actually came from and why it is landing in our markets right now. Corporate pension funding ratios jumped from 99.5% to 105% during 2024, and that swing created approximately $68 billion in excess capital that investment committees are now required to deploy according to their fund guidelines. According to Milliman's Pension Funding Index, this is the strongest funding position our corporate pension system has held in over 15 years. You might think pension managers would be thrilled about this surplus, and they were for about 5 minutes. Then they had to answer the hard question. Where do we invest this money to maintain our funding ratio and meet our future obligations? Our traditional bond market offers yields that barely keep pace with inflation when you account for real purchasing power. Stock valuations are at levels where even optimistic analysts are warning about limited upside and significant downside risk if we hit any economic turbulence. Real estate markets in most major cities are already expensive and showing signs of stress. That leaves alternative assets, and pension committees are being forced to consider allocations they've historically avoided. This is where silver enters the conversation at the institutional level. According to BlackRock's institutional survey on alternative assets, pension fund managers are increasingly viewing precious metals not as speculation, but as strategic inflation hedges required for portfolio resilience. The conversation has shifted from should we own metals to how much do we need to properly hedge our liabilities. And when you're managing a fund with 20 or 30-year obligations to retirees, even a small percentage allocation to strategic metals represents billions of dollars in actual buying. Here's what you need to understand about how institutional investment committees actually make these decisions. They don't wake up one morning and decide to buy silver on a hunch. They spend months reviewing asset allocation models, consulting with advisors, and getting approval from boards and compliance officers. By the time they're ready to execute purchases in January, the decision has already been made, the capital has been allocated, and the traders have their marching orders. This isn't hot money that disappears at the first sign of volatility. This is patient, strategic capital that stays invested for years. The evidence for this shift is already visible in how pension funds are talking about their portfolios. CalPERS, one of our largest public pension systems, mentioned in their November 2024 asset allocation review that they're exploring strategic commodity exposure to enhance portfolio resilience. That's pension fund language for, we're buying things that hold value when traditional assets don't. The Washington State Investment Board increased their allocation targets for inflation-protected assets in their December rebalancing guidance. These aren't random moves, they're coordinated responses to the same funding pressures hitting pension systems across our country. What makes this moment unique is the convergence of 3 separate forces that rarely align. We have structural supply deficits from 5 years of underinvestment in mining. We have surging industrial demand from sectors that can't substitute away from silver even if prices double. And we have institutional capital that must be deployed according to rebalancing mandates with hard deadlines in January. Any one of these factors would move the market. All 3 hitting simultaneously creates conditions we haven't seen in the silver market in decades. The October squeeze was just institutions testing the waters, seeing what happens when they try to buy modest amounts of physical metal. A few $1 billion of buying pressure caused lease rates to spike, premiums to explode, and metal to fly across oceans on passenger jets. Now imagine what happens when $50 billion tries to enter that same market in the span of a few weeks. The math doesn't work unless prices adjust dramatically higher to ration the available supply among competing buyers. This isn't a prediction about what might happen if everything goes perfectly for silver investors. This is documentation of what's already in motion based on supply deficits that have accumulated for 5 years, industrial demand that's locked into growth trajectories, and institutional mandates that force buying regardless of price. The proof isn't in some analyst's forecast. The proof is in the vaults showing declining inventory, the factories placing orders they can't fill, and the pension committees finalizing allocations they must execute in January. The question isn't whether this pressure hits the market. The question is what price is required to clear the orders when it does. Let me walk you through the math that is about to reshape our understanding of what silver is actually worth when institutions treat it as a strategic asset rather than a speculative trade. Global pension funds control approximately $50 trillion in assets under management. That's our retirement money, our teachers' pensions, our firefighters' future security. Standard portfolio diversification practice suggests that any new asset class should represent at least 0.1% of total holdings to have meaningful impact on risk-adjusted returns. We're talking about the absolute minimum allocation that meets basic diversification standards. Do that math with me. If global pension funds allocate just 0.1% of their $50 trillion to silver, that means $50 billion of capital trying to enter a market where annual mine supply is worth approximately $25 billion at current prices, according to the Silver Institute. We have $50 billion trying to buy into a market that produces $25 billion worth of new supply each year, and that's assuming industrial users don't compete for the same metal. The entire market would need to double just to absorb 1 year of minimal institutional allocation. This isn't a scenario where prices drift higher over months as institutions slowly build positions. This is a supply-demand imbalance that forces immediate price discovery to levels that ration available metal among desperate buyers. BNP Paribas already projects silver hitting $100 per ounce by the end of 2026, and that forecast assumes normal market conditions without the pension tsunami we're describing. Now, let's get specific about timing, because the calendar is what turns this from interesting theory into imminent event. January the 2nd through January 10th, 2026 creates what traders are calling the perfect storm window for silver. Here's why those 8 trading days matter more than any other period in the coming year. First, institutions return from the holiday break with approved purchase orders that were finalized in December board meetings. Investment committees don't trade during the last 2 weeks of the year, but the first week of January is when those decisions get executed. And this year, they're all executing the same strategy simultaneously. Second, quarterly rebalancing hits. According to Bloomberg's institutional trading calendar, the first 10 days of January see the heaviest rebalancing volume of the entire year as funds reset their allocations. This isn't unique to 2026, but this year the rebalancing mandates are pointing towards silver instead of away from it. Third, the Bloomberg Commodity Index mechanically adjusts its weightings in early January based on prior year performance. Silver's 67% gain in 2024 combined with rising futures. Volume means the index needs to increase silver's weighting, which triggers automatic buying from index funds and ETFs. According to State Street's commodity fund flows, approximately $5 to $10 billion in passive capital could be forced into silver purchases just from index rebalancing in the first 2 weeks of January. Think about what happens when these 3 catalysts fire simultaneously. Active pension funds buying to meet rebalancing mandates, passive index funds buying to match benchmark weightings, and industrial users trying to secure supply before prices run away. That's potentially $15 to $20 billion trying to execute in 8 trading days. The market can't absorb that without violent price moves. But here's where the story gets even more interesting. The real crisis doesn't hit in January when pension funds are buying. The real crisis comes in the second quarter of 2026 when solar manufacturers discover they can't source enough silver paste to meet their production quotas. According to the Solar Energy Industries Association, solar manufacturers have already signed contracts to deliver panels that require approximately 140 million ounces of silver in 2026. Those contracts were priced months ago based on silver trading in the 30 range. Now imagine you're a solar panel manufacturer in April 2026, and silver is trading at $85 because pension funds absorbed all available supply. You have contracts to deliver panels, but you can't get the silver paste needed for production because every ounce is locked up in institutional vaults. You're not going to eat a 200% increase in raw material costs and destroy your margins. You're going to shut down the production line. The first factory shutdown due to critical material shortage changes everything. Up until that moment, silver is a precious metal that investors trade and industries use. The day a major manufacturer shuts down because they can't source silver, it becomes a strategic commodity that governments care about. Think about what happened when chip shortages hit the automotive industry. Suddenly, semiconductors weren't just another component. They were strategic assets that countries stockpiled and protected. Silver is about to go through that same transformation. Once silver gets reclassified from precious metal to strategic commodity, you'll see actions that make current price targets look conservative. Export restrictions from major producing countries protecting their domestic industries, government stockpiling programs ensuring critical supply for defense and technology sectors, potential strategic reserves announced by the Department of Commerce to secure our supply chains. Each of these developments removes metal from the available pool and drives prices even higher. According to the Congressional Research Service report on critical minerals, our government already classifies 50 different minerals as critical to economic and national security. But silver isn't on that list yet because market prices have been low enough that supply disruption seemed unlikely. That changes the moment we see factory shutdowns or if geopolitical tensions threaten supply from major producers like Mexico or Peru. The reclassification happens quickly once it starts, and it drives institutional buying that makes pension fund allocation look modest by comparison. Here's what you need to understand as an American watching these systems interact. When pension funds, industrial users, and governments all decide they need to own silver at the same time, the available supply gets rationed by price. And price goes to whatever level is required to force some buyers out of the market. The timeline is clear. January's 2nd through 10th brings the initial institutional buying wave that establishes new price floors. Second quarter 2026 brings the industrial crisis when manufacturers can't source material. And sometime in the back half of 2026, our government and others reclassify silver as a strategic commodity and begin securing supply regardless of price. Each phase builds on the last, and each phase removes the possibility of returning to prices that made sense when silver was just another precious metal that investors traded casually. What makes this moment different from past silver rallies is the permanence of the demand. The 1980 Hunt Brothers squeeze was driven by speculative buying that evaporated when prices crashed. This is driven by pension mandates that don't change, industrial demand that keeps growing, and potential government intervention that locks up supply for years. Once silver crosses into strategic commodity territory, there's no going back. So here's what this means for anyone paying attention to our financial markets and the systems that manage our collective wealth. We're watching a supply-demand imbalance that took 5 years to build. We're watching institutional capital that must deploy in weeks. And we're watching an industrial system that can't function without a metal that's running out. The math says prices must rise dramatically. The calendar says it happens soon. And the broader implications say this changes how we think about silver for years to come. This isn't about fear or panic. This is about recognizing patterns before they become obvious to everyone, understanding the mechanisms that drive our markets, and making informed decisions based on what the data actually shows rather than what conventional wisdom assumes. Our pension funds are about to learn an expensive lesson about the difference between paper wealth and physical assets. The question is whether we learn that lesson alongside them or ahead of them.